Pairs trading strategy. Pairs trading is a market-neutral strategy that allows traders to profit from the relationship between two correlated securities rather than betting on the direction of the entire market. Instead of asking whether stocks will rise or fall, traders focus on the performance gap between two assets that historically move together. When that gap widens beyond normal levels, traders buy the underperformer and sell the outperformer, expecting the spread to close. The main principle is mean reversion. Over time, prices of correlated assets tend to return to their historical relationship. By trading the spread rather than the market, pairs trading reduces exposure to market-wide events and focuses instead on relative value. The strategy became widely known during the 1980s when hedge funds began using statistical arbitrage models. These models analyzed thousands of stock pairs and executed trades automatically when opportunities appeared. Today, retail traders can access similar tools on trading platforms. Pairs trading appeals to those who want a systematic approach to trading that is less dependent on predicting market direction. However, success depends on selecting the right pairs, timing entries and exits correctly, and managing risks carefully. The strategy is not risk-free, as correlations can break down during unexpected events, but with discipline and proper tools, it can be a powerful addition to a trader's toolkit. Just a quick reminder to please hit the like button and subscribe to the channel for more great content like this. Also, you can visit us at investmenttees.com and use code BLOG to receive 25% off your next purchase. Pairs trading involves taking opposite positions in two correlated securities. If stock A and stock B usually move together but temporarily diverge, a trader might buy A and short B. The expectation is that the two will realign, creating a profit when the spread returns to normal. The goal is market neutrality. A trader's profit does not depend on whether the market rises or falls but on the relative performance of the two stocks. This makes the strategy attractive during volatile or uncertain market conditions. The mechanics of pairs trading rely on identifying two securities with a strong historical relationship. Traders track the spread between their prices or returns. When that spread diverges significantly from its average, it may indicate an opportunity. The trader simultaneously goes long on the undervalued security and short on the overvalued one. If the relationship reverts to its mean, both trades close with a profit. If the divergence continues, the position may result in losses. For this reason, traders often use statistical measures like correlation and co-integration to strengthen confidence in a pair before entering trades. Finding the right pair is critical. Typically, traders select two companies in the same industry with similar business models. For example, large soda manufacturers or competing technology firms. A strong historical correlation increases the chance that their prices will move together in the future. Statistical tools help confirm suitability. Traders analyze correlation coefficients to measure how closely two stocks move together. A high correlation does not guarantee profits but improves the likelihood of reversion. Co-integration tests help identify long-term equilibrium, adding confidence that divergences are temporary. Correlation is a measure of how closely two securities move together, ranging from 1 to 1. A value near 1 suggests that the two stocks rise and fall in sync. However, correlation alone may not guarantee long-term stability. Co-integration provides a deeper view. It identifies whether two securities share a consistent equilibrium relationship over time. Even if they diverge in the short term, co-integration suggests they are likely to return to balance. Traders who use both correlation and co-integration together reduce the risk of choosing pairs that fail to converge. A systematic approach is essential for pairs trading. The process begins with identifying a suitable pair using historical data. Once identified, traders monitor the spread between the two. If the spread moves beyond a defined threshold, a trading signal is generated. The trader enters long and short positions simultaneously, aiming to profit when the spread narrows again. The strategy continues with monitoring and eventually closing the trade when the spread returns to its mean. Some traders automate this process, but even manual traders rely heavily on consistent rules. Discipline is crucial, as entering too early or failing to exit at the right moment can turn a promising trade into a loss. Entry signals are typically based on statistical thresholds. One common method is standard deviation bands around the historical mean spread. For example, if the spread between two stocks widens by more than 2 standard deviations, it may signal a trading opportunity. Other traders use moving averages or z-scores to standardize the spread and identify extremes. The key is consistency. By defining clear entry rules, traders avoid relying on guesswork and maintain discipline when opportunities arise. Exiting trades at the right time is as important as entering. A typical exit strategy involves closing positions once the spread returns to its historical mean. Some traders use partial exits, closing part of the position as the spread narrows and holding the rest for further gains. Stop-loss orders provide protection if the spread widens instead of converging. Without proper exit rules, traders risk watching profitable positions turn into losses. Consistency in exit criteria ensures that profits are locked in and risks are minimized. Pairs trading is often called market neutral, but it still carries risks. The assumption of mean reversion may not always hold. Sometimes the divergence widens or persists for long periods. Unexpected market events can also break historical relationships. Risk management protects capital. Traders manage exposure by controlling position size, using stop losses, and diversifying across multiple pairs. By treating pairs trading as a systematic process with clear rules, traders improve their chances of long-term profitability. Examples help illustrate how pairs trading works in practice. Traders often choose pairs within the same industry because these companies share similar economic drivers. The strategy is not about predicting which company will succeed but about profiting from temporary misalignments. Classic pairs include consumer goods rivals and large technology firms. By monitoring their price relationships, traders can identify opportunities when spreads deviate from historical norms. Here is a real-world example to consider. Coca-Cola and Pepsi are direct competitors in the beverage industry. Their stock prices often move together, reflecting similar business conditions. Suppose Coca-Cola's stock rises sharply while Pepsi remains stable. A trader may short Coca-Cola and go long Pepsi, expecting Pepsi to catch up or Coca-Cola to revert. If the prices return to alignment, the spread narrows and the trader profits. This example shows how pairs trading relies on relationships rather than absolute performance. Pairs trading has clear strengths but also limitations. Understanding both helps traders decide when and how to apply the strategy effectively. On the positive side, it reduces market exposure and can generate profits in both rising and falling markets. However, traders must recognize that relationships can break and profits depend on precise execution. The main drawback is that correlations may not hold during crises or structural changes in the market. When relationships break, the strategy can generate losses instead of profits. Transaction costs from frequent trading can also reduce returns. Success requires continuous monitoring and discipline to cut losses quickly when trades go against expectations. Conclusion: pairs trading remains one of the most practical and accessible market-neutral strategies available. By focusing on relationships rather than direction, traders can find opportunities even in uncertain markets. The key lies in selecting the right pairs, defining entry and exit rules, and managing risks carefully. For traders seeking a systematic, disciplined method that reduces exposure to market-wide risks, pairs trading offers a compelling option. Thanks for watching.